The year is 2008. Lehman Brothers collapses. The global economy is on fire. Central banks across the world reach into their emergency toolbox and pull out a weapon they swore they'd only use once: quantitative easing. They flood the system with trillions of dollars. They promise it's temporary. They promise they're in control. They promise inflation will stay tame. And for a while, it works. Prices stay stable. Markets recover. The system survives. But here's what they didn't tell you. They broke something that day. Something fundamental. Something they can't fix. Because in 2024, inflation is back. And this time, the central banks are powerless. You've been told your entire life that central banks control inflation. That when prices rise, they simply raise interest rates, pull money out of the system, and everything goes back to normal. That's the story. That's the textbook answer. But what if I told you that story is dead? What if the tools that worked for 40 years no longer work? What if the entire monetary system we've relied on since the 1980s has quietly, invisibly, catastrophically failed? This isn't theory. This isn't doom-mongering. This is what's happening right now. And by the end of this video, you'll understand exactly why the people in charge have lost control, and what that means for your savings, your income, and your future. Before we go any further, let me ask you something. If central banks are so powerful, why is inflation still raging despite the fastest interest rate hikes in 40 years? Why are prices still climbing even after the Fed drained trillions from the economy? Think about that. And if you want the real answer, the one nobody's talking about, then stay with me. Because what I'm about to show you will change how you see the entire global economy. Let's start with the first failure. The balance sheet trap. In 2008, the Federal Reserve's balance sheet was under $1 trillion. By 2020, it had ballooned to over $4 trillion. Then COVID hit. And in the span of just 18 months, it exploded to $9 trillion. $9 trillion. That's not a policy. That's a structural mutation. The Fed didn't just print money to fight a recession, it became the market. It bought bonds, mortgages, corporate debt. It propped up asset prices. It became the single largest player in the financial system. And once you do that, you can't go back. Because if the Fed tries to shrink its balance sheet too fast, the entire system implodes. Bond markets freeze. Stock markets crash. Credit dries up. So they're stuck. They expanded to save the economy, and now they can't contract without destroying it. That's the trap. Here's why this matters for inflation. When the central bank holds trillions in assets, it's not just creating money, it's creating expectations. Investors know the Fed will step in during a crisis. Businesses know they'll get bailed out. Markets know there's a floor, so they take bigger risks. They borrow more. They spend more. And all that activity, all that risk-taking, all that borrowing, it generates demand. Demand pushes up prices. And once prices start rising, the Fed is supposed to cool things down by raising rates and shrinking its balance sheet. But they can't. Because shrinking the balance sheet means crashing the markets. So inflation keeps climbing, and the central bank is paralyzed. They can nudge interest rates up, sure. But they can't undo the structural distortion they've created. The balance sheet isn't just big, it's a trap. And the Fed is caught in it. Now let's talk about the second failure. Fiscal monetary fusion. For most of modern history, central banks and governments were separate. The central bank controlled money. The government controlled spending. That separation was sacred. It was the foundation of monetary credibility. But in 2020, that wall collapsed. When COVID hit, governments didn't just spend, they unleashed a fiscal fire hose. Trillions in stimulus checks, unemployment benefits, business loans, infrastructure spending. And how did they pay for it? They didn't. The central banks did. The Fed bought government debt. The ECB bought government debt. The Bank of Japan, the Bank of England, they all did the same thing. It was monetary financing in everything but name. Governments spent, and central banks printed. The line between fiscal and monetary policy disappeared. Here's the problem. Once you fuse fiscal and monetary policy, inflation becomes inevitable. Because now it's not just about controlling the money supply, it's about politics. Governments love spending. It wins votes. It funds programs. It keeps people happy. And if the central bank is willing to finance that spending, why would any government ever stop? They won't. So spending becomes permanent. Deficits become permanent. And money printing becomes permanent. That's not a crisis response anymore. That's the new normal. And in that world, inflation isn't a bug. It's a feature. Because the only way to finance endless deficits without collapsing the bond market is to inflate away the debt. That's what's happening. Central banks didn't lose control of inflation, they surrendered it. They chose fiscal dominance over price stability. And now they can't go back. Let me give you an example. Look at the United States. In 2020, the government sent out stimulus checks. Trillions of dollars, straight into people's bank accounts. Where did that money come from? It didn't come from taxes. It didn't come from savings. It came from the Federal Reserve printing money and buying treasury bonds. That's direct monetary financing. And it worked for a while. People spent the money. The economy rebounded. Unemployment dropped. But prices exploded. Because you can't inject trillions of new dollars into the economy without consequences. Every dollar printed dilutes the value of every other dollar. That's inflation. And once it starts, it's almost impossible to stop, especially when the government is still running trillion-dollar deficits and the central bank is still buying debt. The system is locked in. Now here's where it gets worse. Central banks know this. They understand the trap they're in. But they can't admit it. Because if they admit they've lost control, confidence collapses. Bond markets panic. Currencies crash. So instead, they pretend. They raise interest rates. They talk tough about fighting inflation. They project strength. But behind the scenes, they're still holding trillions in government debt. They're still financing deficits. They're still trapped in the system they created. And the longer they pretend, the worse the problem gets. Because inflation isn't just about money printing, it's about credibility. And every day they delay, every month they pretend they're in control, their credibility erodes a little more. And once credibility is gone, inflation becomes unanchored. It becomes a self-fulfilling spiral. Prices rise because people expect them to rise. And expectations are the one thing central banks cannot control with interest rates. Let's move to the third failure. Global supply shocks. For decades, central banks operated in a world of abundant supply. Globalization meant cheap labor. Open trade meant cheap goods. Stable energy markets meant cheap inputs. Inflation was a demand problem. If demand got too hot, you raised rates, cooled demand, and prices stabilized. Simple, predictable, effective. But that world is gone. The supply-side paradigm has collapsed. And central banks are still fighting the last war. Start with energy. For 20 years, oil prices were stable. Fracking boomed. OPEC was weakened. Energy was cheap and reliable. But in 2022, Russia invaded Ukraine. Europe cut off Russian gas. Energy prices spiked. Not because of demand. Not because central banks printed money. But because supply disappeared overnight. The Fed can raise rates all it wants. It won't bring Russian gas back online. It won't rebuild European energy infrastructure. It won't reverse geopolitical conflict. Energy inflation is structural. And central banks are powerless against it. Then there's manufacturing. For decades, globalization meant outsourcing. Companies moved production to China, Vietnam, Mexico, anywhere labor was cheap. Supply chains stretched across oceans. It was efficient. It was profitable. And it kept prices low. But COVID shattered that system. Factories shut down. Ports clogged. Shipping costs exploded. And even after the pandemic, the system didn't bounce back. Because the world is reshoring. Companies are moving production back home. Governments are subsidizing domestic manufacturing. Trade barriers are rising. Globalization is reversing. And that means higher costs. Permanently higher costs. Because producing goods in Ohio is more expensive than producing them in Shenzhen. Central banks can raise interest rates, but they can't reverse deglobalization. They can't force companies to offshore again. Supply-side inflation is here to stay. And then there's food. Climate change is hammering agricultural production. Droughts in California. Floods in South Asia. Heat waves in Europe. Crop yields are falling. Food prices are rising. And it's not temporary. It's structural. The planet is getting hotter. Weather is getting more extreme. Food production is getting more volatile. Central banks can't fix that with monetary policy. They can raise rates to crush demand, sure. But that just means people go hungry. It doesn't solve the underlying problem. Food inflation is driven by climate, not credit. And no interest rate hike will change that. Here's the mechanism. In the old world, inflation was mostly about demand. People spent too much, prices rose, central banks raised rates, people spent less, prices stabilized. The system was closed. The central bank had leverage. But in the new world, inflation is about supply. And supply is determined by geopolitics, climate, trade policy, energy infrastructure, things completely outside the central bank's control. So when inflation surges, central banks raise rates. But it doesn't work. Because demand isn't the problem. Supply is. And all they're doing is crushing the economy without fixing the underlying cause. That's why inflation is persisting. That's why rate hikes aren't working. The world has changed, but central banks are still using old tools for a new problem. They're bringing a knife to a gunfight. Let me give you a concrete example. In 2022, inflation in the UK hit 11%. The Bank of England raised rates aggressively, from 0.1% to 5% in just 2 years. That's one of the fastest tightening cycles in history. And what happened? Inflation stayed high. Why? Because UK inflation was driven by energy prices. Natural gas prices had quintupled. Electricity costs doubled. The Bank of England raised rates, and all it did was push the economy toward recession. It didn't bring gas prices down. It didn't rebuild energy infrastructure. It didn't solve the supply shock. It just made everything worse. Families couldn't afford mortgages. Businesses cut jobs. And inflation, still high. Because monetary policy doesn't work when the problem is structural. Now let's talk about the fourth failure. Wage price spirals. This is the one central banks fear most. And it's already happening. Here's how it works. Prices rise. Workers notice. They demand higher wages to keep up. Businesses raise wages to keep employees. But higher wages mean higher costs. So businesses raise prices to protect margins. And then workers demand even higher wages because prices went up again. It's a feedback loop. A spiral. And once it starts, it's incredibly hard to stop, because it becomes embedded in expectations. Workers expect annual raises. Businesses expect to pass costs on to customers. And inflation becomes self-perpetuating. For decades, this wasn't a problem. Unions were weak. Workers had no leverage. Globalization meant companies could offshore if wages got too high. So wage growth stayed low. Inflation stayed low. Everyone was happy. Well, except the workers. But COVID changed everything. Labor markets tightened. Workers gained leverage. The Great Resignation happened. People quit bad jobs. They demanded better pay. And businesses, desperate to stay staffed, gave it to them. Wages spiked. And once wages rise, they almost never come back down. Because people won't accept pay cuts. They'll quit first. So wages become sticky. And that stickiness feeds inflation. Here's the data. In the United States, wage growth in 2021 and 2022 was the highest in 40 years. In some sectors, wages rose 6, 7, even 8% annually. That's great for workers, in the short term. But it's disastrous for inflation. Because businesses don't absorb wage costs. They pass them on. A restaurant pays cooks more, so it raises menu prices. A factory pays workers more, so it raises product prices. A hospital pays nurses more, so it raises healthcare costs. And suddenly, everything is more expensive. And when everything is more expensive, workers demand even higher wages. The spiral accelerates. Central banks see this happening. They know wage price spirals are dangerous. So they raise interest rates to cool the labor market. The theory is simple. Higher rates slow the economy. Businesses hire less, unemployment rises, workers lose leverage, wage growth slows, inflation cools. But here's the problem. To break a wage price spiral, you need a recession. A deep one. Because workers won't accept lower wages unless they're desperate. And businesses won't stop raising prices unless demand collapses. So the central bank has to crush the economy. They have to cause mass layoffs. They have to push unemployment high enough that workers lose all bargaining power. That's the only way to break the spiral. And that's exactly what central banks are trying to do right now. But they're failing. Because labor markets are still tight. Workers still have leverage. And wage growth is still elevated. Why? Because the labor market has structurally changed. Globalization is reversing. You can't offshore jobs as easily anymore. Immigration has slowed. Birth rates are falling. The workforce is aging. In the US, Europe, and Japan, there are fewer workers entering the labor market than leaving it. That's a demographic shift. And it's permanent. You can't fix a labor shortage with interest rates. You can raise rates to 10%, and it won't create more workers. It'll just shrink the economy. And in a shrinking economy with a labor shortage, inflation stays high because labor costs stay high. Central banks are trapped again. They need unemployment to rise to break the wage spiral. But structural labor shortages mean unemployment won't rise enough unless they trigger a full-scale depression. And they can't do that without destroying the entire system. Let me show you what this looks like in practice. Germany, the industrial heart of Europe. For decades, Germany thrived on cheap Russian energy and low-wage manufacturing. But now Russian gas is gone. Energy costs have tripled. And German manufacturers are struggling. They're paying workers more because labor is scarce. They're paying more for energy because supply is tight. And they're raising prices to survive. But higher prices mean lower demand. And lower demand means layoffs. But even with layoffs, wages aren't falling. Because workers have options. They move to other countries. They retrain for different jobs. They retire early. The labor pool is shrinking. And in a shrinking labor pool, wage inflation persists. The Bundesbank can raise rates. The ECB can tighten. But they can't reverse demographics. They can't create workers out of thin air. So inflation stays high. And Germany, the economic engine of Europe, is stuck. Now let's connect all four failures. Massive balance sheets. Fiscal monetary fusion. Supply shocks. Wage price spirals. Each one alone would be a crisis. Together, they're a systemic breakdown. Because they're all interconnected. The balance sheet trap means central banks can't shrink their holdings without crashing markets. Fiscal monetary fusion means governments keep spending and central banks keep financing. Supply shocks mean inflation is driven by factors central banks can't control. And wage price spirals mean inflation is self-perpetuating. These forces are feeding off each other. They're amplifying each other. And central banks are caught in the middle, paralyzed, reactive, and losing credibility by the day. Here's the terrifying part. Central banks know all of this. They're not stupid. They see the trap. They understand the structural shifts. But they're prisoners of the system they built. They can't admit failure. They can't tell the public that inflation is beyond their control. Because if they do, panic sets in. So instead, they keep pretending. They raise rates incrementally. They talk about data dependence. They project calm. But behind closed doors, they're terrified. Because every tool they have either doesn't work or makes things worse. Raise rates? You crash the economy, but inflation stays high because it's supply-driven. Shrink the balance sheet? Markets collapse and credit freezes. Stop buying government debt? Bond yields spike and governments can't finance deficits. Do nothing? Inflation spirals and currency devalues. There is no good option. Every path leads to pain. The only question is who suffers and how much. Let's talk about what this means for you. If central banks can't control inflation, that means inflation stays high. Maybe not 8 or 9% like in 2022, but 3, 4, 5% annually, well above the 2% target. That might not sound catastrophic, but compounded over time, it destroys wealth. A 4% inflation rate means your savings lose half their value in 18 years. Your salary, if it doesn't keep pace, loses half its purchasing power. Your retirement fund, denominated in dollars or euros or pounds, buys half as much. That's not a temporary disruption. That's a generational wealth transfer. From savers to debtors. From workers to asset owners. From the middle class to the rich. And it gets worse. Because if inflation stays high, interest rates stay high. And high interest rates have consequences. Mortgages become unaffordable. Car loans get expensive. Credit card debt spirals. Small businesses can't borrow to expand. Governments pay more to service debt. The entire economy slows. Growth stagnates. Productivity declines. But prices keep rising. That's stagflation. Slow growth, high inflation. The worst of both worlds. And it's exactly where we're headed. Because central banks can't lower rates without reigniting inflation. And they can't raise rates further without collapsing the economy. So we're stuck in a high inflation, high rate, low growth world. For years. Maybe decades. Now here's the part nobody wants to talk about. If central banks have truly lost control, then currencies are at risk. Because the value of a currency depends on trust. Trust that the central bank will protect its value. Trust that inflation will stay low. Trust that the system is stable. But what happens when that trust erodes? What happens when people realize the central bank is powerless? They dump the currency. They buy hard assets. Gold. Real estate. Bitcoin. Commodities. Anything that can't be printed. And when people flee the currency, inflation accelerates. Because the currency loses value. And when the currency loses value, import prices spike. And import prices feed into domestic inflation. It's another spiral. A currency spiral. And it's the nightmare scenario for central banks. Because once confidence is lost, it's almost impossible to restore. Look at history. Every time a central bank loses credibility, the result is hyperinflation or currency collapse. Weimar Germany, Zimbabwe, Venezuela, Argentina. It always starts the same way. The government spends more than it earns. The central bank finances the deficit. Inflation rises. The central bank tries to control it. But the tools don't work. Inflation accelerates. People lose faith. Currency collapses. And the economy implodes. Now, I'm not saying the US dollar or the euro will collapse tomorrow. These are still the world's reserve currencies. They have structural advantages. But those advantages are eroding. The dollar's dominance is shrinking. BRICS countries are trading in their own currencies. Saudi Arabia is accepting yuan for oil. Central banks are diversifying reserves away from dollars. The system is fracturing. And if inflation stays high and central banks stay powerless, that fracture could become a break. And if the dollar loses its reserve status, the consequences will be catastrophic. For America. For the world. For everyone holding dollars. Let's talk about another consequence. Asset bubbles. When central banks printed trillions, where did that money go? It didn't go to wages. It didn't go to consumer goods. It went to assets, stocks, bonds, real estate, crypto, venture capital. Every asset class inflated, not because the assets got more valuable, but because there was more money chasing them. That's a bubble. And bubbles always burst. The question is when. And the answer is, when central banks tighten too much or when the economy collapses. We've already seen cracks. The stock market crashed in 2022. Crypto imploded. Tech startups laid off thousands. Real estate is slowing. The bubble is deflating. But here's the problem. If the bubble bursts completely, the economy collapses. Because asset prices underpin the entire financial system. Your pension fund owns stocks. Your bank holds mortgages. Your insurance company owns bonds. If asset prices crash, the whole system unravels. So central banks are stuck again. They need to tighten to fight inflation. But they can't tighten too much or they'll crash the markets. And if they don't tighten enough, inflation spirals. There's no way out. They're balancing on a knife's edge. And sooner or later, they'll slip. Here's a real-world example. Japan. For 30 years, the Bank of Japan has been trapped. They printed money to fight deflation. They bought government bonds, corporate bonds, even stocks. Their balance sheet is bigger relative to GDP than any other major central bank. And it worked, sort of. They avoided deflation. But they also created a zombie economy. Growth is stagnant. Debt is astronomical. And now inflation is back. For the first time in decades, Japanese inflation is above target. So the Bank of Japan should raise rates. But they can't. Because the government debt is so high that even a small rate increase would make the debt unsustainable. Japan would default. So the Bank of Japan is trapped. They're letting inflation run hot because the alternative is economic collapse. That's the future. That's what happens when central banks lose control. And it's not just Japan. It's coming to Europe, to America, to everywhere the central banks printed trillions and fused with governments. The trap is global. Now let's talk about what happens next. Over the next 5 to 10 years, you're going to see a fundamental repricing of everything. Assets, currencies, debt, labor, risk, everything. Because the world is waking up to the fact that the old system is broken. The era of low inflation, low rates, and endless liquidity is over. The new era is high inflation, high rates, and constant instability. And in that world, the winners and losers will be very different. Debtors win. Because inflation erodes the real value of debt. Governments win. Because they can inflate away their deficits. Asset owners win if they hold the right assets. Real estate, commodities, inflation-protected securities. But savers lose. Workers with fixed incomes lose. Retirees lose. Anyone holding cash or bonds loses. Because inflation steals purchasing power. And central banks can't stop it. Let me paint a picture of what this looks like on the ground. Imagine it's 2028. Inflation is running at 4% annually. It's not making headlines anymore because people are used to it. But your grocery bill is 20% higher than it was 3 years ago. Your rent went up 15%. Gas is expensive. Electricity is expensive. Healthcare is expensive. Everything costs more. Your salary went up, sure, but not as much as prices. So every year, you can afford a little less. Your savings account? Still earning 1% interest while inflation runs at 4%. So you're losing 3% a year. Your retirement fund? Stock market returns are mediocre because the economy is stagnating. So your nest egg is shrinking in real terms. Meanwhile, the government's debt keeps growing. But nobody cares because inflation is eroding it. And the rich? They're fine. Because they own real assets. Real estate that appreciates with inflation. Stocks in companies that can pass costs to consumers. Commodities that rise with prices. They're insulated. But you're not. That's the new normal. And it's already starting. Here's the question you need to ask yourself. If central banks can't stop inflation, what can you do? How do you protect yourself? How do you survive, and maybe even thrive, in a high inflation world? The answer isn't simple. But it starts with understanding the system. Understanding that cash is trash. That bonds are dangerous. That inflation is a tax on the unprepared. And once you understand that, you can start positioning yourself. Not with speculation. Not with gambling. But with strategy. Own assets that hold value. Reduce exposure to debt you don't control. Increase income streams that adjust with inflation. Build resilience. Because the storm is here. And it's not passing anytime soon. Let's talk about the political consequences. Because inflation doesn't just destroy wealth, it destroys trust. Trust in institutions. Trust in governments. Trust in the system. And when people lose trust, they revolt. Not always with violence, but with votes. With protests. With radicalism. Look at history. The 1970s. Stagflation ravaged the West. Trust in government collapsed. Political extremism surged. Unions went on strike. Governments fell. It was chaos. And it ended only when central banks jacked rates to 20% and triggered the worst recession since the Depression. That's what it took to break inflation. Pain. Suffering. Mass unemployment. Are we willing to go through that again? Is society stable enough to survive it? I don't know. But I do know that inflation is already fueling populism. Left and right. People are angry. They're scared. They don't understand why prices keep rising. And when politicians can't fix it, they'll turn to extremists who promise simple solutions. That's how democracies collapse. Not with a coup, but with a slow erosion of trust until the system breaks. And here's the global dimension. Inflation isn't just a Western problem. It's hitting the developing world even harder. Because developing countries import energy and food. And when prices spike, they can't afford it. Sri Lanka collapsed. Pakistan is on the edge. Egypt is struggling. Lebanon is in ruins. These aren't isolated crises. They're symptoms of a global system under strain. And the more inflation persists, the more countries will collapse. And when countries collapse, people flee. Refugees. Migration crises. Geopolitical instability. It's all connected. Central bank policy failures in the West ripple across the world. And the consequences are catastrophic. Let me show you the mechanism in slow motion. When the Fed prints dollars, those dollars flow around the world. Because the dollar is the global reserve currency. Emerging markets borrow in dollars. They trade in dollars. They save in dollars. So when the Fed prints, it creates inflation everywhere. But when the Fed tightens, it sucks dollars out of the global system. And that causes crises. Because countries that borrowed in dollars suddenly can't pay back their loans. Their currencies collapse. Their economies implode. This happened in the 1980s. Latin American debt crisis. It happened in the 1990s. Asian financial crisis. And it's happening now. Because the Fed is tightening. And emerging markets are suffering. And there's nothing they can do about it. Because they don't control the dollar. The Fed does. And the Fed doesn't care about Sri Lanka or Pakistan. It cares about American inflation. So the Fed will keep tightening. And emerging markets will keep collapsing. That's the brutal reality of a dollar-dominated system. And it's another reason why the global financial order is fracturing. Now let's talk about what central banks will do next. Because they're not going to give up. They'll try new tools, new strategies, new experiments. Some are already talking about central bank digital currencies, CBDCs. The idea is simple. Replace cash with a digital currency controlled directly by the central bank. That gives the central bank unprecedented power. They can track every transaction. They can control who spends what and where. They can even program the money to expire if you don't spend it fast enough. It's a technocrat's dream. But it's also a nightmare for freedom, because it gives the state total control over your financial life. And in a world where central banks are desperate, where inflation is out of control, where trust is eroding, CBDCs are the next step. They'll sell it as innovation, as efficiency, as fighting crime. But the real reason is control. Because when you can't control inflation with interest rates, you try to control people instead. Another tool they'll try: yield curve control. That's where the central bank caps long-term interest rates by promising to buy unlimited government bonds. Japan does this. Australia tried it. The idea is to keep borrowing costs low even as inflation rises. But it's a dangerous game, because if inflation keeps rising and the central bank is capping rates, real interest rates go negative. And negative real rates mean savers are punished. It means currency devalues. It means inflation accelerates. Yield curve control is a last-ditch tool. And the fact that central banks are even considering it tells you how desperate they are. Then there's fiscal dominance. We've already talked about this. But it's going to get worse. Governments will pressure central banks to keep rates low and keep financing deficits. And central banks will comply. Because the alternative is government default. And default would destroy the financial system. So central banks will sacrifice their independence. They'll become arms of the Treasury. Monetary policy will become fiscal policy. And inflation will become the tool to manage debt. That's not conspiracy theory. That's basic political economy. And it's already happening in Japan, Europe, and the US. The Fed talks about independence. But when the government is running trillion-dollar deficits, the Fed has no choice but to buy bonds. Because if it doesn't, yields spike, and the government can't finance itself. So the Fed is trapped. And trapped central banks print money. And printed money causes inflation. Here's what a lot of people don't understand. Central banks aren't independent by accident. They were made independent to keep governments from abusing the money supply. Because when governments control money, they print to pay for wars, welfare, pork barrel spending, anything that wins votes. And that causes inflation. That causes currency collapse. That's why we separated fiscal and monetary policy in the first place. But that separation is gone. The wall has been breached. And there's no going back. Because once governments taste the power of monetary financing, they'll never give it up. So we're in a new era. An era of fiscal dominance. An era where central banks serve governments. And in that era, inflation is the price we pay for political stability. Or political survival. Depending on how you see it. Now let's talk about what this means for geopolitics. Because inflation isn't just an economic problem. It's a strategic weapon. Look at the US-China rivalry. The US has enormous debt. Over $30 trillion. And it's growing. How does the US manage that debt? It inflates it away. If the dollar loses 3% of its value every year, the debt burden shrinks in real terms. That's convenient. But it also means the dollar loses credibility. And that opens the door for China. Because China wants the yuan to be a global reserve currency. And every time the US inflates, every time the Fed prints, every time dollar credibility erodes, China gains. Saudi Arabia starts accepting yuan. Russia trades in yuan. BRICS countries build yuan-denominated systems. The dollar's dominance is slipping. Not fast, but steadily. And if inflation stays high, that slide accelerates. Because nobody wants to hold a currency that's constantly losing value. And here's the kicker. If the dollar loses reserve status, the US loses its superpower privilege. Right now, the US can print dollars and the world accepts them. That's an enormous advantage. It means the US can run deficits forever. It can finance wars, welfare, infrastructure, all on borrowed money. Because the world needs dollars. But if the world stops needing dollars, that advantage disappears. And suddenly, the US has to live within its means. That's a seismic shift. It would force fiscal austerity. It would shrink the military. It would reduce America's global influence. And it would destabilize the entire international order. Because the post-1945 world was built on dollar dominance. If that collapses, everything changes. Alliances shift. Trade routes shift. Power shifts. And we enter a multipolar, unstable, dangerous world. All because central banks couldn't control inflation. Let me give you a scenario. It's 2030. Inflation in the US is running at 5% annually. The Fed has given up on the 2% target. It's now targeting 4%, but even that's aspirational. Meanwhile, the yuan is gaining ground. BRICS countries are trading in yuan. Oil is priced in yuan. China has launched a digital yuan that's used across Asia. The dollar is still dominant, but its share of global reserves has fallen from 60% to 45%. And it's dropping every year. US bond yields are at 6% because investors demand a premium for inflation risk. The government is paying over $1 trillion a year just in interest. That's more than the defense budget. The Fed is stuck buying bonds to keep yields from spiking further. But that means more money printing, which means more inflation, which means more loss of confidence. It's a doom loop. And the only way out is a crisis so severe it forces structural reform. But structural reform means pain. And nobody wants pain. So the system limps along, degrading slowly, until one day it doesn't. That's the future. That's what happens when central banks lose control. Now let's talk about the psychology of inflation. Because inflation doesn't just affect your wallet, it affects your mind. When prices keep rising, you change your behavior. You buy now instead of later, because you know prices will be higher tomorrow. That's called inflation expectations. And it's incredibly powerful. Because when everyone expects inflation, everyone acts in ways that cause more inflation. Businesses raise prices preemptively. Workers demand raises preemptively. Consumers hoard goods. It becomes a self-fulfilling prophecy. And once inflation expectations are embedded, they're almost impossible to reverse. Because you have to break people's psychology. You have to convince them that prices will stabilize. And the only way to do that is with credibility. But central banks have lost credibility. They said inflation was transitory. It wasn't. They said they had the tools. They didn't. They said they were in control. They aren't. So why would anyone believe them now? Here's a historical parallel. In the 1970s, inflation became embedded. People expected it. Unions negotiated contracts with automatic cost of living adjustments. Businesses raised prices every year as a matter of course. Inflation fed on itself. And it took Paul Volcker, the Fed chair, to break it. He raised interest rates to 20%. He triggered a brutal recession. Unemployment hit 10%. Businesses failed. People lost their homes. It was agony. But it worked. Inflation broke. Expectations reset. And the economy recovered. But here's the question. Could we do that today? Could we survive a Volcker-style shock? I'm not sure. Because the economy is more fragile now. Debt levels are higher. Asset bubbles are bigger. Social cohesion is weaker. A 20% interest rate today would trigger a depression, not a recession. It would collapse governments. It would spark revolutions. So central banks won't do it. They'll let inflation run. They'll hope it stabilizes on its own. They'll pray for a miracle. But miracles don't happen in economics. Only consequences. Let's zoom out. What is inflation, really? It's a loss of purchasing power. It's your money becoming worth less. But it's also a tax. A hidden tax. Because when the government prints money and prices rise, you pay the cost. Your savings shrink. Your wages buy less. You work just as hard, but you're poorer. That's inflation. And it's the cruelest tax of all. Because it's invisible. It's gradual. It's easy to deny. But over time, it devastates the middle class. Because the middle class holds cash. They save in bank accounts. They don't own vast portfolios of stocks and real estate. So when inflation hits, they're the most vulnerable. And that's not an accident. It's the system working as designed. Because inflation benefits debtors and punishes savers. And the biggest debtor is the government. So inflation is a tool of the state. A way to reduce debt without raising taxes. A way to fund deficits without explicit austerity. And central banks enable it, whether they admit it or not. Here's the uncomfortable truth. Central banks aren't failing by accident. They're failing because the system they operate in is broken. A system built on endless debt, endless growth, endless money printing. That system worked for a while, but it was always unsustainable. Because you can't print wealth. You can only print money. And when you print too much money, it loses value. That's inflation. And we've printed too much. Way too much. For decades. And now the bill is coming due. Central banks tried to delay it. They tried to manage it. They tried to pretend it wasn't happening. But reality doesn't care about central bank models. Reality is asserting itself. And the reality is that we've built an economy on sand. And the tide is coming in. Let me take you back to basics. What gives money value? Trust. The belief that tomorrow it will be worth roughly what it is today. That you can save it, and it will hold value. That you can trade it, and others will accept it. That's trust. And trust is fragile. It's built over decades and destroyed in moments. Central banks are the guardians of that trust. Their job is to keep money stable. To keep inflation low. To keep the system working. But they've broken that trust. They've prioritized short-term stability over long-term soundness. They've bailed out banks, funded governments, inflated assets, and ignored the consequences. And now the consequences are here. Inflation is high. Confidence is low. And trust is eroding. Once trust is gone, money is just paper. And paper can burn. So what's the end game? There are a few possibilities. 1. Central banks regain control. They hike rates aggressively, trigger a deep recession, break inflation, and restore credibility. Pain in the short term, stability in the long term. But I don't think they'll do this. Because the political will doesn't exist. Because voters won't tolerate mass unemployment. Because governments are too indebted to survive a recession. So option 1 is unlikely. 2. Inflation stays elevated. Not hyperinflation, but persistent 3 to 5% inflation for years. A slow grind. A gradual erosion of wealth. Governments inflate away debt. Workers lose purchasing power. Asset owners stay rich. The middle class shrinks. Society becomes more unequal. Trust in institutions declines. Populism rises. This is the most likely scenario. And it's grim. 3. A major crisis forces a reset. A financial collapse. A currency crisis. A sovereign default. Something so severe that the system can't continue. And out of the ashes, a new system emerges. Maybe it's a gold standard. Maybe it's a digital currency. Maybe it's a basket of commodities. Whatever it is, it's not the current system. Because the current system breaks. This scenario is less likely in the next few years. But over a decade or two, it's possible. Because unsustainable systems don't last forever. 4. Hyperinflation. Central banks lose all credibility. Governments print money without restraint. Prices spiral out of control. The currency collapses. This is the nightmare scenario. And while I don't think it's likely for the US or Europe, it's not impossible. History is full of great powers that thought they were immune, right up until they weren't. Now, I want to be clear. I'm not saying the sky is falling tomorrow. I'm not telling you to panic. But I am telling you to pay attention. Because what's happening right now is a fundamental shift. The rules that governed the economy for 40 years are breaking. The tools that central banks relied on aren't working. And the system we took for granted is failing. This isn't temporary. This isn't a blip. This is structural. And it will shape the next decade of your life. Your savings. Your career. Your future. Here's what you need to understand. In a high inflation world, cash loses value. Bonds lose value. Fixed incomes lose value. But real assets, things with intrinsic value, hold up. Real estate, if you can afford it. Commodities. Stocks in companies with pricing power. Inflation-protected securities. These are the hedges. Not because they're guaranteed to win, but because they're better than holding cash that's guaranteed to lose. This isn't financial advice. I'm not a financial advisor. But this is logic. And logic says that in an inflationary environment, you want to own things that can't be printed. Things that retain value when currencies don't. But beyond your personal finances, think about the bigger picture. Think about what kind of world you want to live in. Because the choices we make now, as individuals, as societies, will determine whether we slide into stagnation and instability or whether we force the painful reforms needed to build something better. And those reforms will be painful. They'll require austerity. They'll require tough decisions. They'll require giving up the easy money, the bailouts, the printing. But if we don't make those choices, the market will make them for us. And the market is far less forgiving than policymakers. Let's talk about what ordinary people can do. Because this isn't just about investors or elites. This is about everyone. If you're a worker, you need to think about your career. Are you in an industry that can pass costs on to customers? Are your skills in demand? Can you negotiate for raises that keep pace with inflation? If not, you're falling behind. Think strategically. Invest in skills that retain value in an inflationary environment. If you're a business owner, think about resilience. Can you hedge input costs? Can you diversify suppliers? Can you raise prices without losing customers? Inflation is a threat, but it's also an opportunity, if you're prepared. If you're a saver, think about alternatives to cash. Inflation-protected bonds. Real assets. Diversification. Don't keep all your wealth in depreciating currency. And if you're young, think long-term. This is the world you're inheriting. Understand it, adapt to it, and position yourself to thrive, not just survive. Here's the bigger point. Central banks were supposed to be the adults in the room. The technocrats who kept the system stable. The guardians of the currency. But they've failed. Not because they're incompetent, but because the system they were asked to manage is unmanageable. You can't run trillion-dollar deficits forever. You can't print money forever. You can't inflate asset bubbles forever. Eventually, reality reasserts itself. And when it does, central banks, with all their PhDs and models and credibility, are powerless. They can nudge. They can delay. They can pretend. But they can't stop the inevitable. And the inevitable is here. I want to end with a thought experiment. Imagine you're a central banker. You've spent your career studying economics. You believe in the models. You believe in the tools. You believe you can control inflation. But then COVID hits. You print trillions. Inflation surges. You raise rates. But it doesn't work. Supply shocks hit. Wages spiral. Fiscal policy runs wild. And you realize you're not in control. You never were. You were just riding a wave of favorable conditions. Low inflation wasn't because of your brilliance. It was because of globalization, cheap energy, weak labor, and luck. And now the luck has run out. So what do? You keep pretending. Because if you admit you've lost control, the system collapses. So you project confidence. You talk about data dependence. You adjust rates by quarter points. And you hope, desperately hope, that something changes. that inflation falls on its own, that the crisis passes, that you can retire before it all falls apart. That's the reality. And it's terrifying. So here we are. 4 policy failures, a broken system, central banks out of ammunition, and inflation entrenched. This is the new normal. Not temporary, not transitory, structural, and it's going to reshape the world. Geopolitics will shift as the dollar declines. Wealth will concentrate as inflation punishes the middle class. Trust will erode as institutions fail. And instability will rise as societies fracture. This isn't doom-mongering. This is pattern recognition. This is history repeating. Because every time central banks lose control, the consequences are catastrophic. And we're watching it happen in real time. But here's the strange thing. Most people don't see it. They see inflation. They see higher prices. But they don't connect the dots. They don't understand that this is systemic, that it's not going away, that the central bank can't save them. And maybe that's for the best. Because if everyone understood, panic would set in. Bank runs, currency flight, collapse. So maybe ignorance is a kind of social glue, a way to keep the system limping along a little longer. But ignorance doesn't protect you. It just delays the reckoning. And the reckoning is coming, whether we see it or not. Let me give you one more example. Turkey. For years, Erdogan pressured the central bank to keep rates low. He didn't believe in orthodox economics. He thought low rates would boost growth. So he fired central bank governors who disagreed. And the central bank complied. Rates stayed low. And inflation exploded. Turkish lira collapsed. People's savings evaporated. The economy cratered. And now Turkey is stuck in a high inflation, low growth trap. The central bank lost all credibility. And once credibility is gone, it's almost impossible to get back. Turkey is a case study in what happens when central banks are politicized. When they lose independence. When they serve governments instead of guarding the currency. And it's a preview of what's coming to the West. Maybe not as extreme. Maybe slower. But the same dynamics are at play. Fiscal dominance. Political pressure. Loss of credibility. And inflation. Now let's talk about the social contract. Because inflation breaks it. The social contract says, work hard, save money, follow the rules, and you'll be okay. You'll be able to afford a home. Retire with dignity. Give your kids a better life. That's the promise. But inflation destroys that. You work hard, but your wages don't keep up. You save money, but it loses value. You follow the rules, but you fall behind. Meanwhile, people who took on debt get rewarded. People who owned assets get richer. The system feels rigged. And it is rigged. Not by conspiracy, but by structure. By a system that prioritizes asset prices over wage growth, liquidity over stability, short-term fixes over long-term soundness. And when people realize the system is rigged, they stop believing in it. They stop trusting institutions. They stop following the rules. And society fractures. This is already happening. Look at the rise of populism, left and right. People are angry. They don't trust elites. They don't trust experts. They don't trust the system. And can you blame them? Central bankers said inflation was transitory. It wasn't. Economists said globalization would lift all boats. It didn't. Politicians said the system was fair. It's not. So people turn to outsiders, to radicals, to anyone who promises to burn it all down. And maybe that's rational. Because if the system isn't working, why preserve it? This is the political consequence of central bank failure. Instability, radicalism, decline. And we're only at the beginning. Let me take you deeper into the mechanism. Why did central banks expand their balance sheets so much? Because after 2008, private credit collapsed. Banks stopped lending. Businesses stopped borrowing. The economy was in freefall. So central banks stepped in. They became the lenders of last resort. Not just to banks. To everyone. They bought bonds, mortgages, corporate debt. They flooded the system with liquidity. And it worked. The economy recovered. But it also created a dependency. Because now the system relies on central bank liquidity. Without it, credit dries up. Markets crash. The economy contracts. So central banks can't step back. They're stuck providing liquidity forever. And every time they try to reduce it, the system wobbles. So they reverse course. They expand again. And the balance sheet grows. And grows. And grows. Until it's so big that it distorts everything. That's where we are now. Central banks are not just part of the economy. They are the economy. And that's the trap. Here's another angle. Energy. I mentioned earlier that energy shocks are a supply-side problem. But let's go deeper. Why are energy prices high? Because we're transitioning away from fossil fuels. But renewable energy isn't ready to replace them. Solar and wind are intermittent. Batteries are expensive. Infrastructure takes decades to build. So we're stuck in a transition where we're shutting down old energy sources before new ones are ready. That creates shortages. And shortages mean higher prices. This is a policy choice. Maybe it's the right choice for the climate. But it's a choice with consequences. And one of those consequences is inflation. Because energy is an input to everything. Food, manufacturing, transportation. When energy prices rise, everything rises. And central banks can't fix that. They can't make solar panels more efficient. They can't build nuclear plants. They can't reverse the energy transition. So they're powerless. And inflation persists. Now let's talk about demographics. Birth rates are falling across the developed world. Japan, Europe, America. Fewer babies means fewer workers. Fewer workers means labor shortages. Labor shortages mean higher wages. Higher wages mean higher costs. Higher costs mean higher prices. And central banks can't print workers. They can encourage immigration, but that's political. They can incentivize birth rates, but that takes decades. So demographic inflation is structural. It's baked in. And it's going to get worse as boomers retire. Because boomers are a huge generation. And when they leave the workforce, they create a gap. A gap that can't be filled. Not by technology. Not by productivity. Not by monetary policy. This is a long-term trend. And it's inflationary. And central banks are powerless against it. Let me connect the dots. Balance sheet expansion. Fiscal monetary fusion. Supply shocks. Wage spirals. Energy transition. Deglobalization. Demographics. These are all structural forces. They're not temporary. They're not cyclical. They're the new baseline. And they're all inflationary. So when you ask, why can't central banks stop inflation? The answer is, because inflation is no longer monetary. It's structural. And monetary policy, interest rates, balance sheet adjustments, those are tools for monetary inflation. They don't work on structural inflation. That would require different tools. Fiscal policy, industrial policy, trade policy, energy policy, labor policy. But central banks don't control those. Governments do. And governments are paralyzed. By politics. By debt. By short-term thinking. So the tools that could fix inflation aren't being used. And the tools that are being used don't work. That's the crisis. Let's talk about inequality. Because inflation exacerbates it. Rich people own assets. Stocks. Real estate. Businesses. When inflation rises, asset prices often rise too. Because assets are real. They have intrinsic value. So the rich get richer. But poor people hold cash. They live paycheck to paycheck. When inflation rises, their purchasing power falls. So the poor get poorer. And the middle class? They're squeezed. Their wages don't keep up. Their savings erode. Their debt becomes harder to service. So the middle class shrinks. This isn't a bug. It's a feature. High inflation transfers wealth from workers to asset owners. From the poor to the rich. From the productive to the rentier class. And central banks enable this. Maybe not intentionally, but structurally. Because their policies favor asset prices over wages. Liquidity over stability. The financial sector over the real economy. And the result is a more unequal, more divided, more unstable society. Here's a scenario. It's 2035. Inflation has been running at 4 to 6% annually for over a decade. The dollar has lost 40% of its value. Savings accounts are worthless. Bonds are toxic. Stock markets are volatile but stagnant in real terms. Real estate is absurdly expensive. Wealth is concentrated in a tiny elite. The middle class has collapsed. Gig economy work is the norm. Pensions are insolvent. Social security is bankrupt. Healthcare is unaffordable. Education is a luxury. And people are angry. Protests are common. Political violence is rising. The government is gridlocked. Infrastructure is crumbling. And everyone blames everyone else. Boomers blame millennials. Workers blame immigrants. The left blames the rich. The right blames the government. But nobody blames the real culprit, a monetary system that broke. A central bank that failed. A society that chose easy money over hard choices. That's the future, if we don't change course. But here's the paradox. Changing course requires pain. It requires austerity, spending cuts, tax increases, debt reduction, structural reform. And nobody wants pain. Voters reject it. Politicians avoid it. Central banks delay it. So we stay on the same path. The path of least resistance. The path of inflation. The path of slow decline. And we tell ourselves it's fine. That it'll work out. That someone will fix it. But nobody's coming to fix it. There is no deus ex machina. No magical solution. Just consequences. And the longer we wait, the worse they get. Let me ask you a question. What do you owe to the future? To your kids? To the next generation? Do you owe them a stable currency? A functioning economy? A world that isn't drowning in debt and inflation? Or do you owe yourself comfort? Easy money? Low rates? Bailouts? Stimulus? I'm not saying there's a right answer, but the choice we make, collectively, as a society, will determine what kind of world we leave behind. And right now, we're choosing comfort. We're choosing to let central banks print, to let governments spend, to let inflation run, because the alternative is hard. And we're not ready to be hard. Not yet. So here's the bottom line. Central banks can't stop inflation because the forces driving it are beyond their control. The balance sheet trap means they can't shrink without crashing markets. Fiscal monetary fusion means they're prisoners of government debt. Supply shocks mean inflation is real, not monetary. And wage price spirals mean it's self-perpetuating. These aren't problems monetary policy can solve. They're structural. They're political. They're global. And they're not going away. So inflation is here to stay. Maybe not at 8%, but at 3, 4, 5%. Higher than the target. Higher than we're used to. And persistent. For years. Maybe decades. And that changes everything. This is the world we live in now. A world where money loses value. Where savers are punished. Where workers fall behind. Where trust erodes. Where instability rises. It's not the world we wanted, but it's the world we built. Through decades of easy money. Of kicking the can. of prioritizing today over tomorrow. And now tomorrow is here. And it's not pretty, but it's real. And we have to deal with it. Not with denial, not with hope, but with clear eyes and hard choices. Because the alternative is collapse. And collapse is worse than pain. So what comes next? Over the next decade, we're going to see a massive repricing of assets, of currencies, of risk, of expectations. Things that seemed stable will wobble. Things that seemed certain will fracture. The post-war economic order, built on dollar dominance, free trade, and central bank omnipotence, is ending. Not with a bang, but with a long, slow grind. And in its place, something new will emerge. Maybe it's multipolar. Maybe it's regional. Maybe it's digital. I don't know. But I know it won't be the same. Because the system that got us here is broken. And broken systems don't heal. They collapse and get replaced. And here's the thing. Most people won't see it coming. They'll wake up one day and wonder why their savings are gone. Why their paycheck buys so little. Why everything feels harder. And they'll blame immigrants, or billionaires, or politicians, or China. But the real culprit is the system. A system that relied on central banks to hold it together. And central banks failed. Not because they were malicious, but because they were asked to do the impossible. To manage an economy built on unsustainable debt with tools designed for a different era. They tried. They failed. And now we're living with the consequences. But here's a glimmer of hope. Systems break, but people adapt. Humans are resilient. We've been through hyperinflation before. Currency collapses. Depressions. Wars. And we survived. We rebuilt. We adapted. This time will be no different. It'll be painful. It'll be chaotic. But we'll get through it. And on the other side, maybe, just maybe, we'll build something better. Something more sustainable. Something that doesn't rely on endless debt and money printing. Something that values stability over speculation. Savings over consumption. The future over the present. That's the hope. It's a distant hope. But it's there. So what should you do? Stay informed. Don't trust the official narrative. Don't assume the central bank has it under control. Look at the data. Look at the trends. Look at history. And position yourself accordingly. Protect your wealth. Invest in yourself. Build resilience. And most importantly, understand what's happening. Because knowledge is the only real hedge in a world of uncertainty. You can't control inflation. You can't control central banks. But you can control your response. And in a chaotic world, that matters. Let me leave you with this. The era of central bank omnipotence is over. The era of low inflation and easy money is over. The era of stability is over. We're entering a new era. An era of higher inflation, higher volatility, and higher stakes. It's going to be uncomfortable. It's going to be challenging. But it's also going to be defining. Because the choices we make now, how we respond, how we adapt, how we prepare, will determine not just our financial futures, but the kind of world we live in. So pay attention. Stay sharp. And don't assume the people in charge know what they're doing. Because they don't. They're making it up as they go. Just like the rest of us. This is the reality. Central banks have lost control. Inflation is structural. The system is breaking. And we're all along for the ride. The question is, are you going to be a passenger, blindly hoping someone else will fix it? Or are you going to take the wheel and navigate your own path through the storm? Because the storm is here. And it's not passing anytime soon. The mechanisms are clear. The balance sheet trap locks central banks into perpetual expansion. Fiscal monetary fusion ties their hands to political agendas. Supply shocks, energy, food, labor, hit from angles monetary policy can't reach. And wage price spirals become self-perpetuating feedback loops that entrench inflation into the economy's DNA. Each failure compounds the others. Each attempted solution creates new problems. The central banks are trapped in a labyrinth of their own making, and every turn leads deeper into the maze. And the costs are mounting. Real wages are falling. Savings are evaporating. Debt burdens are growing. Inequality is widening. Social trust is fracturing. Political extremism is rising. These aren't abstract economic concepts. They're lived realities for millions of people. The grandmother watching her fixed pension buy less each month. The young couple who can't afford a home. The worker whose raise doesn't keep pace with grocery bills. The small business owner crushed between rising costs and price-sensitive customers. These are the human faces of central bank failure. And there are millions of them. But perhaps the most insidious consequence is the erosion of truth itself. Because when central banks lose credibility, people stop believing in expertise. If the experts were wrong about inflation being transitory, what else are they wrong about? If the models don't work, why trust the modelers? If the institutions failed, why trust institutions? This epistemological crisis spreads beyond economics. It undermines science, medicine, journalism, any field that requires trust in expert knowledge. And once that trust is gone, society becomes atomized. Everyone retreats into their own bubble of belief. Conspiracy theories flourish. Demagogues rise. And rational discourse becomes impossible. That's the hidden cost of central bank failure. Not just economic chaos, but social fragmentation. The breakdown of the shared reality that holds societies together. So we stand at a crossroads. One path leads through painful but necessary reform. Fiscal discipline. Structural adjustment. Honest accounting of debts and liabilities. A return to sound money principles. It would hurt. There would be a recession, maybe a deep one. Unemployment would rise. Asset prices would fall. But on the other side would be stability. A system built on solid ground. A currency that holds value. Institutions that regain credibility. That's the hard path. The path of integrity. The other path is the path we're on. Continued inflation. Continued money printing. Continued fiscal dominance. Continued denial. It's the easy path in the short term. No dramatic crisis. No political backlash. Just a slow grind. A gradual decline. A steady erosion of living standards. Until one day we wake up and realize we've become a different kind of country. Poorer. Less stable. Less trusted. Less free. That's the soft path. The path of least resistance. And it's the path we're likely to take. Because humans are optimists. We always think things will work out. That someone will fix it. That it won't get that bad. But history shows otherwise. And the signs are already here. You've watched this video because something inside you knows the official story doesn't add up. You've felt the squeeze. You've seen the prices rise. You've watched your paycheck shrink in real terms. You've sensed that something fundamental has broken. And you're right. It has. The system that promised stability has delivered chaos. The institutions that promised protection have delivered failure. The experts who promised answers have delivered excuses. And now you know why. 4 policy failures. 4 structural breaks. 4 reasons why central banks can't stop inflation anymore. Not won't. Can't. Because the tools they have don't match the problems they face. And no amount of rate hiking or balance sheet adjustment will change that. So what happens now? That's up to all of us. We can demand accountability. We can demand reform. We can demand honesty from our institutions. Or we can continue sleepwalking into decline. The choice is ours, collectively. But individually, you have a choice too. To adapt. To prepare. To see the world as it is, not as we wish it to be. To protect what matters. To build resilience. To stay informed and stay ahead. Because in a world where the rules are changing, The survivors are those who change with them. The battle between central banks and inflation is over. Inflation won. Not because it's stronger, but because the battlefield changed. The war is no longer monetary, it's structural. And until we address the structural problems, inflation will persist. Higher for longer isn't a prediction anymore. It's the reality. And we're all living in it now. If this video opened your eyes to the mechanisms behind today's inflation crisis, if it helped you see past the narratives to the underlying structural failures, then you understand something most people don't. You understand that we're not in a temporary rough patch. We're in a paradigm shift. And paradigm shifts define generations. This will define ours. The question is, how will you respond? Will you be crushed by forces you don't understand? Or will you navigate them with clear eyes and strategic thinking? That choice is yours. But you have to make it now. Because the world isn't waiting. Thank you for staying with me through this deep dive into the mechanisms of our unraveling monetary system. This isn't easy material. It's not comfortable. But it's necessary. Because understanding is the first step to adaptation. And adaptation is the first step to survival, and maybe even prosperity, in the world that's coming. If you want to continue this journey, if you want to understand what comes next and how to prepare for it, stay with this channel. Because the story isn't over. In fact, it's just beginning. And the next chapter might be the most critical one of all. I'll see you there.